Welcome back to Lamb's Cryptoverse. Today I want to talk to you about 3 or 4 things that I see going on with the market. So let me get out my notes because it's too much to remember. The first one is the debt ceiling. The second thing I want to talk to you about is economic data, and then distinguish between soft economic data and hard economic data. The third thing I want to talk to you about is what's going on with the market. So speaking of which, let's see how the market did today. So I'm recording this on a Friday, June 2nd. And let me just see. Yep. And the market went up like crazy. The Dow was up 700 points, the Nasdaq 140 points, and S&P was up 61 points, up 1.5%. Now this is even above where I said the market would go or could go. Do you remember I was bullish? I'm trying to remember when it was. I think it was in March, thinking the market could go higher. But then about a month ago, I put out a bearish signal thinking the market was getting too speculative, I should say. And I said the market could go up to around 4,200. So if the market goes up any higher, I'm going to admit I was wrong. But what I depend on a lot of contrarian and sentiment indicators, and they're telling me the market's speculative. But so maybe I could be wrong, but it looks like we're near a major resistance point. Because if you look here, and you go like year to date on S&P, for example, you can see that there's a lot of resistance around 4,200. So that's important to look at. Let's see. Oh. So let's go to the next chart. Let me just show myself. So what I want to talk to you about is data. We've got a lot of soft economic data saying the economy is well soft. And this economic data includes the leading economic index, which is down 0.6%, and it's been going down for months. And ISM PMI index, that's the Purchasing Managers Index, that's been below 50 for many months. It's at 46.9, and the new orders index plunged to about, I think it was below 40, which is basically at a recession data point. However, this is what I see. The hard economic data points have been very good. For example, the consumer spending has been strong, about 1%. First quarter GDP was up 1.3%. Durable goods, including business investment, have been up 1.1%. And today, the labor report, I like to call it the unemployment report, the labor report was up, meaning it had 339,000 jobs. About 340,000 jobs were created. And that is way, way above the 190,000 estimated jobs. Even if we did 190,000 jobs, that would be indicative of a very strong economy. So what I see going on now is economic news, especially hard economic news, is actually getting stronger. But at the same time, Jay Powell and the Fed governors have been leaking that they want to hold. They do not want to raise rates. So I find this very contradictory because Jay Powell has been saying that inflation is too high. I'm not sure what data points you look at for inflation, but most of them, like the PCE, Personal Consumption Expenditure Index, and others are saying that inflation is above 4%, but Jay Powell is looking for 2%. And he did, in his previous remarks, say that he would raise and possibly hold. But now, to me, doesn't look like a good time to hold because economic data is getting stronger. Yes, economic data is lagged, but the funny point is he's picking the wrong time to stop raising rates because, as I said earlier, economic data points are getting stronger, indicating the economy is stronger. But so far, it looks like he's going to hold because what he does is he leaks the data out. So he's leaking. He had 2 Fed governors leak out that they're not going to raise rates. They're just going to hold. So that's another reason why the stock market's going up like crazy. The other reason why the stock market is rising, as you probably know, is because of AI. Yes, generative artificial intelligence, as they call, is all the rage now. Forget about crypto. That's old news. Everyone's looking at Nvidia and OpenAI slash Microsoft, and Elon Musk is getting into it. That's what everyone wants to talk about right now. And C3 AI, that's what people are talking about. And Charlie Bilello, he was kind enough to point out that when things do poorly, they tend to reverse the next year, and vice versa. When they do well, they tend to reverse. And so here he's pointing out, if you look at the left side, that tech was down dramatically last year, and now it's up dramatically. And I'm going to show you here that that what I'm charting is the technology ETF versus the spider ETF versus the Russell 2000. This one doesn't look good. I'm going to change this right now on the fly and put the year-to-date return. Now, if you look at the year-to-date return, let's choose the year-to-date. You can see that the tech ETF is up 33%, while the S&P Spider is only up 10%. And this is not even a Spider equal weighted. If you looked at the Spider equal weighted index, it would be much less than 10%. And if you look at the Russell 2000, it's up less than 1% year to date. And that's including today's 4%, whatever it was, gain on the Russell 2000. Otherwise, the Russell 2000 would have been down. So that's how much the FANG stocks plus Microsoft and Nvidia have been going up relative to the rest of the market. So basically, the soldiers are not following the generals. And here, speaking of Nvidia, you can see that Nvidia is up 172% year to date. That, my friends, is crazy. Sooner or later, the market, including Nvidia, is going to revert back to the mean. Why? Because it always does. And if you look at the Fear Greed Index, it's at greed. And from a contrarian point of view, that ain't good, my friends. That means we're near the peak of the market, at least short term. And this is a longer term view. You can see that in red, we have the S&P, and in blue, we have the CNN Fear Greed Index. And usually, when the blue index is above 60, which is where we are now, the market is peaking. But the market, for some reason, hasn't peaked and gone down. It keeps going up. So this is a pretty rare event, my friends, what we're seeing here. And I don't have the data because it's not out yet, but the put-to-call ratio, I reckon, is going to be at one of the lowest ratios we've seen in the last year. I'm guessing that for today, June 2nd, we're going to have a put-to-call ratio of only 0.5, meaning we've got a lot of people buying calls. And as a matter of fact, I think we have twice as many calls being bought as puts. So that's what I call a speculative frenzy. And then why is it people that I like, that have done well historically, like Stanley Druckenmiller, George Soros, Jim Rogers, Mike Wilson over at Morgan Stanley. He's a chief strategist. And my favorite guy right here, Dan Niles. Speaking of Nvidia, Dan Niles knows his computer and semiconductors. He used to be a semiconductor analyst like 20, 30 years ago. And then he started managing the Satori Fund. And he's very good at risk management. He, my friends, is not bullish. He is bearish, especially for the short term. So why is it that all the people that I follow that are good, that have a good historical track record, are bearish? So what I think we're seeing is a classical FOMO where investors, and in particular, not the ones you think I'm about to see. I think it's institutional investors. They're getting overly speculative, and because remember, institutional investors had too much cash, and you could tell because they were shorting the S&P 500. How do I know that? Because I look at the futures exchanges. I should just get a few right now. I look at, let me see if I could get it quickly. I think it's from the CME. Yeah, Commitment of Traders. Here it is. It's right here. So this is the Commitment of Traders. As I said, it's from the Commodity Futures Trading Corporation, if I said it right. And you can see if you click on the S&P 500 mini futures, you can see in green the professional traders have been shorting the S&P. So what you see now is short covering from institutional investors. So beware, because this cannot continue. So beware. And I think what I learned from my FRM, that's an exam, financial risk management exam, is that you have to be very careful when everyone's getting speculative and being FOMO, and and vice versa. You have to be very aggressive and bullish when the market's declining and everyone's getting bearish. You have to be a contrarian. And remember, I still think we're in. If you don't believe that in technical analysis or sentiment analysis, think about this. I still think we're in a regime where monetary policy and liquidity remain tight. So you don't want to be overly aggressive in this type of environment.